If you walked into a bank today and they offered to double your money, the first question out of your mouth shouldn't be, "Where do I sign?" It should be, "How long will it take?" Time is the invisible variable that makes or breaks your entire financial life. Most people think calculating compound interest requires a spreadsheet, a specialized calculator, or a degree in finance. But it doesn't. There is a single number, a specific, slightly strange integer that unlocks the entire timeline of your wealth. That number is 72. If you divide 72 by your interest rate, you know exactly how many years it takes for your capital to double. It sounds like a parlor trick, but it is actually one of the most robust tools for cutting through marketing noise. Whether you are looking at an investment, a savings account, or a credit card debt, this rule tells you the truth about speed. And in finance, speed is everything. I realized a long time ago that most investors are flying blind. They see a 7% return and they think, that sounds okay. But they don't intuitively know what 7% actually means for their retirement date. Does it mean you retire in 10 years? Or 30? The gap between those two numbers is your entire life. Today, I am going to walk you through the rule of 72. We are going to look at the math behind it, why it works, and how to use it to measure investment growth. But more importantly, I am going to show you the dark side of this rule, how it predicts the destruction of your purchasing power through inflation and the explosion of your liabilities through debt. If you enjoy deep dives into the mechanics of money without the hype, do me a favor and subscribe. It is the best return on investment for your time that I can offer. Let's get into the numbers. Here is the problem with the human brain. It is terrible at exponential growth. We are linear creatures. If you take 30 linear steps, you cross the street. If you take 30 exponential steps, you circle the Earth 26 times. We just cannot visualize it. When a financial advisor tells you that your portfolio will grow at 8% a year, your brain interprets that as a slow, steady, straight line upward. But compound interest is a curve, and curves are deceptive. They start slow, barely moving, and then suddenly shoot vertical. Because we lack the intuition for this, we tend to make terrible decisions. We delay investing because the early results look boring. Or we ignore a 3% fee because 3 sounds like a small number. We need a translation layer. We need a way to turn percentages into time. That is where the rule of 72 comes in. It converts abstract rates into concrete years. It answers the question, when do I get twice as much money as I have today? The formula is deceptively simple. You take the number 72 and you divide it by your annual rate of return. The result is the number of years it takes to double your money. Let's run a few scenarios so you can feel how this works. If you find a high-yield savings account paying 4%, you take 72 and divide it by 4. That gives you 18. It will take 18 years for your money to double in that account. Now, let's look at the stock market. Historically, the S&P 500 has returned roughly 10% nominally over long periods. 72 divided by 10 is 7.2. That means every 7.2 years, your portfolio should theoretically double. Compare those two timelines. In the savings account, you wait nearly 2 decades for one double. In the market, you get almost 3 doubling periods in the same amount of time. That is the difference between having $20,000 and having $80,000, just based on the doubling speed. Now, you might be asking, why 72? Why not 100 or 50? It's not magic. It's a mathematical coincidence involving natural logarithms. To find the exact doubling time, you use the natural log of 2, which is approximately 0.693. In a perfect mathematical world, we would use the rule of 69.3. But try dividing 69.3 by 7 or 8 in your head while you're standing in line at the grocery store. It's a nightmare. The number 72 is chosen because it is close enough to 69.3 to be accurate, but it is also a highly composite number. It has so many factors. You can divide 72 cleanly by 2, 3, 4, 6, 8, 9, and 12. This makes it the ultimate mental shortcut. It's an engineer's approximation designed for the real world. Is it perfect? No, but it gets you within a few months of the correct answer for most typical investment returns, which is all you need for a gut check. So, doubling your money sounds great. We all love to calculate how rich we're going to be. But there is a trap here. Most people use the rule of 72 to fantasize about their future wealth, but they forget to use it to calculate their current poverty. The same math that grows your assets is currently working 24 hours a day to destroy them. I'm talking about the invisible tax that no one votes for, but everyone pays: inflation. And if you think a little bit of inflation doesn't matter, you need to run the number 72 in reverse right now. We often hear central banks targeting an inflation rate of 2 or 3%. It sounds harmless. Oh, my coffee costs 3% more this year. I can handle that. But applying the rule of 72 shows you the grim reality of purchasing power. Instead of calculating how long it takes for your money to double, we calculate how long it takes for your money's value to be cut in half. If inflation is running at 3%, you divide 72 by 3. That gives you 24. In 24 years, every dollar you saved in cash will buy half as much as it does today. If you retire at 60 and live to 84, your cash savings have effectively lost 50% of their engine power just by sitting there. That is the silent killer of retirement plans. Now, let's look at what happens when inflation spikes, like we have seen in recent economic cycles. If inflation hits 6%, take 72 divided by 6. That is 12 years. In just 12 years, your money is worth half. If you are saving for a house down payment in cash, and inflation is 6%, the target isn't just moving away from you, it is sprinting. This is why the safe option of keeping money under the mattress is actually the risky option. In a high inflation environment, cash is a guaranteed loss. The rule of 72 exposes this mercilessly. It forces you to realize that if your investments aren't generating a return higher than the inflation rate, you aren't actually standing still. You are moving backward, and the rule tells you exactly how fast you are falling. The psychology here is dangerous because the erosion is slow enough to ignore on a daily basis. It's the boiling frog experiment. You don't notice the price of bread going up 5 cents at a time until you look back 10 years later and realize your grocery bill has doubled. By using the rule of 72, you bring that future pain into the present. You realize that safety has a cost. When you keep $50,000 in a checking account earning 0%, you aren't preserving capital. You are effectively paying a subscription fee to inflation to hold that money. If inflation is 4%, you are paying a 4% wealth tax. The rule of 72 converts that percentage into a timeline. In 18 years, this money is half gone. That visceral realization is usually enough to wake people up and get them to invest. So, what is the protocol? You have to view your hurdle rate as the inflation rate. If inflation is 3%, your investments must return 3% just to break even. Anything above that is your real return. If you earn 7% in the market and inflation is 3%, your real return is 4%. Now, use the rule of 72 on that real return. 72 divided by 4 is 18. It takes 18 years to double your purchasing power, not just the number on the screen. This is the only way to plan honestly. Stop looking at nominal returns, look at real returns. It's a tougher standard, but it's the only one that matters when you're actually trying to buy groceries in 20 years. Now we have to talk about the flip side. We've talked about assets growing and cash shrinking. But what about liabilities? This is where the Rule of 72 turns from a helpful tool into a horror movie. If you carry credit card debt, you are on the wrong side of the equation. You aren't the investor, the bank is the investor, and you are the investment vehicle. And let me tell you, the returns they are getting from you are spectacular. Let's run the numbers on what high-interest debt actually does to your future. The average credit card interest rate often hovers around 18 to 24%. Let's take 24% because it makes the math easy and the reality terrifying. 72 divided by 24 is 3. That means if you didn't make payments, the debt would double every 3 years. Now, obviously, you make minimum payments, so the balance doesn't literally double on paper, but the cost doubles. The amount of interest you generate for the bank is compounding at a rate that doubles the principal obligation rapidly. If you have $10,000 in debt at 24%, the mathematical pressure pushing that balance up is immense. It is fighting you with the strength of a 3-year doubling period. Compare that to your investments. You might be sweating to earn 8% in the stock market, doubling your money every 9 years. Meanwhile, your debt is compounding at 24%, trying to double every 3 years. The debt is 3 times faster than your investment. This is why you cannot out-invest high-interest debt. It is mathematically impossible over the long run. The Rule of 72 shows you the velocity difference. It's like trying to run up a down escalator that is moving 3 times faster than you are. You will never reach the top. You have to kill the debt first because its doubling engine is simply more powerful than any doubling engine you can build in the stock market. The protocol here is simple. Identify the interest rate on every debt you own. Apply the Rule of 72. If the result is under 10 years, meaning the rate is over 7.2%, that debt is an emergency. It is a hair-on-fire situation. Mortgage debt at 4%? That's an 18-year double. That's manageable. You can likely beat that in the market. But a personal loan at 12%? That doubles every 6 years. That has to go. Use the rule to triage your financial life. The lower the number of years to double, the higher the priority to pay it off. It gives you a clear mathematical hierarchy of what to attack first. Let's shift gears to something more optimistic. Planning your freedom. When people try to figure out retirement, they usually get bogged down in complex Monte Carlo simulations. Those have their place, but for a quick sanity check, the Rule of 72 is superior. It allows you to think in terms of doubling windows. This is a concept I use to visualize how many times I can multiply my net worth before I die. It changes your perspective from saving monthly to waiting for the cycle. Let's say you're 30 years old. You have $50,000 invested. You expect a 7% return. 72 divided by 7 is roughly 10 years. That means you have a doubling window every decade. From 30 to 40, your 50K becomes 100K. From 40 to 50, it becomes 200K. From 50 to 60, it becomes 400K. And from 60 to 70, it becomes 800K. That is without adding a single extra penny after age 30, just letting the growth engine run. This framework shows you the immense power of the early doubles. If you wait until you are 40 to start, you lose that first double. You start at 40 with 50K, and by 70, you only have 400K. You literally cut your end result in half by missing one 10-year window. The Rule of 72 proves that time is not just linear money, time is a multiplier. However, there is a leak in this boat that we haven't discussed. We assumed you get to keep all that 7% return. But in the real world, the financial industry wants a cut. And they are very clever about how they take it. They take it in small percentages, 1%, 1.5% in management fees. It sounds tiny. What's 1% among friends? Using the rule of 72, I can show you that a 1% fee doesn't just cost you 1% of your money, it costs you years of your life. Let's run the math. Suppose your investments earn a raw return of 8%. 72 divided by 8 is 9 years. You double your money every 9 years. Now, imagine you pay a financial advisor a 2% fee. Your net return is now 6%. 72 divided by 6 is 12 years. Suddenly, your doubling time stretched from 9 years to 12 years. You lost 3 years of speed. Over a 40-year investing career, that is massive. At 8%, you get about 4.4 doubles. At 6%, you only get 3.3 doubles. That one little 2% fee could cost you hundreds of thousands of dollars in final value, because it reduced the frequency of your doubling events. Fees are not just expenses, they are brakes on your compounding engine. I want to be clear about the limitations. The rule of 72 is an estimation tool, not a law of physics. It starts to lose accuracy at the extremes. If you are looking at extremely high rates of return, say 50% or 100%, the math drifts. For example, at 100% return, your money doubles in 1 year. But 72 divided by 100 is 0.72 years. The rule fails there. Similarly, at very low rates like 0.5%, it gets a bit wonky. But for the Goldilocks zone of 3% to 15%, where almost all personal finance happens, it is shockingly accurate. Don't use it to file your taxes. Use it to orient your brain. The other limitation is that the rule assumes a smooth ride. It assumes you get 8% every single year, like a machine. The stock market doesn't work like that. You might get plus 20% one year and minus 10% the next. The average might be 8%, but the volatility creates something called volatility drag, which means your actual money grows a bit slower than the average return implies. So when the rule of 72 says your money will double in 9 years, treat that as a best case or a median scenario. In reality, it might take 10 or 11 years, depending on the sequence of returns. Always build a margin of safety into your mental math. If the rule says 10 years, plan for 12. Being pleasantly surprised is better than being short on cash. So, how do we synthesize this? You now have a mental dashboard. Every time you see a percentage rate, divide 72 by it. Investment opportunity at 6%? Okay, doubles in 12 years. Inflation at 4%? My cash halves in 18 years. Credit card at 24%? Debt doubles in 3 years. This effectively gamifies your financial life. Your goal is to maximize the speed of your asset doubles and minimize or eliminate the speed of your liability doubles. It turns finance from a vague cloud of anxiety into a manageable engineering problem. You are just managing timelines. You are trying to stack as many asset doubling windows as possible into your remaining lifespan. I want you to try this out. Go look at your current investment portfolio or your savings account. Find the interest rate. Do the math in your head right now. 72 divided by that rate. How many years until your next double? Is that number acceptable to you? If it's not, you know what you need to do. Increase the rate or increase the contributions. Let me know in the comments what your doubling number is. I'm curious to see the range we have in this community. And if this way of thinking, mental models over marketing fluff, resonates with you, consider subscribing. I'll keep running the numbers so you don't have to. Thanks for watching, and I'll see you in the next one.